let's straight away address the global markets where we're headed. Drew Pettit, Director, U.S. Equity Strategy at Citi, is now joining in. Drew, the latest AI fear to grip the markets is the disruption, the potential disruption to financial advisory companies, wealth management, tax planning companies. And we saw that in the stock price. Charles Schwab was down 7-8%. LPL Financial got crushed yesterday. How big a disruption is it? Is it just preemptive de-risking, as Prashant put it? Shoot first and then ask questions later. How are you all analyzing the impact on financial services companies?
Yeah, it's funny. I'm going to take this back to like the software discussion and just AI disruption in general. It's not about the near-term earnings. Financials looked really good during earnings season. Software stocks before that looked really good during earnings season, and actually had numbers revised up for the full year and even next year. When we have disruption, when there's new tech and innovation in any industry, it's a problem out in the future. It is what we call a terminal multiple problem. So for software to sell off 20% from its highs, over the past 6 months, it really just took a couple multiple turns out of the terminal multiple. So instead of putting, let's call it a 26 PE on software stocks in 3 years' time, you put a 24 PE on them, and guess what? You have a pretty aggressive sell-off. The same thing could be said of financials today. So again, investors are assessing that long-term risk, but it has a really large impact on values today.
Yeah. So Drew, overdone or not?
I think in software, yes. The way I think about this is if I de-risk the terminal multiple and I stop trading stocks or buying stocks that have to go up because I'm going to put a bigger PE on them in the future and really de-risk that, take that down, make the story not about the multiple going higher, then I feel better. So again, we're dip buyers in software. We still like owning cyclical risk, but understand that no risk, whether it's on the growth side of the market or the cyclical side of the market in the U.S. is cheap right now. So we want to be barbelled. We want to own both so we can manage these really aggressive rotations from one area to the next.
Hi, Drew. Good to see you, Ben. How are you approaching equity markets, though? The developed markets, the mother market, the U.S. market actually has outperformed. At current reckoning, how would you approach global equities between developed markets and emerging markets? And I think in the past you've mentioned that India could be one of the preferred emerging markets. You stick by that?
So we're talking about diversification. So the story we're telling in the US around buy growth and buy cyclicals, we like risk, we like beta. So don't buy GDP plus companies, but don't buy defensives, buy diversified types of risk. That story is the exact same one we're telling globally. We're overweight emerging markets. We like Japan. We're neutral on the United States, and then we're underweight UK and Australia, a little bit kind of less risk, a little bit less cyclicality in those markets. The broadening trade and different opportunities in cyclicals and growth is how we want to position, whether it's in the US or globally. And on India specifically, look, we've been neutral on India within our EM overweight, but we totally understand that the trade news recently can definitely bolster sentiment. It could bolster flows. You could see some more positive action from the FIIs. India's been underweight in a lot of emerging market portfolios. General, we like being there, but we still like some other markets like Taiwan and South Korea a little bit more right now.
So neutral on India in the emerging market basket, Drew, but is there a case to upgrade India?
We'll see. That's something we'll have to talk about in our next global discussion. We tend to look at these things on a quarterly basis. But to us, when we're thinking about any emerging market in this environment right now, it's all about the revision trend. So we'll see how the trade news and earnings season plays out. As revisions shift, that tends to be our focus globally, including in emerging markets.
Yeah. Drew, any other strong sort of views across assets? I mean, so much has happened, right? Gold and silver and oil is, of course, another one. What's any strong views here?
Get some sleep while you can, because the news cycles just keep coming faster and faster, and you see these little pockets of volatility everywhere. But honestly, from a diversification standpoint and from an investor reaction standpoint, what we're seeing is people actually buying more international equities against this backdrop, against volatility in commodities, flows there decelerated. Fixed income's been a really good holding place. Again, diversified fixed income exposure. People are buying different types of credit. It's not just treasuries and safe plays. And then on the equity side, look, I think this is a really important talking point. U.S. investors bought more international equities than they bought home country equities and ETFs in January for the first time in almost 3 years. So you're starting to see global diversification on the equity side play out in a lot of U.S. portfolios right now.
Yeah. Drew, we'll leave it there. Thank you very much for joining us. Get some sleep. I think that's the wise words. But we're starting our day, you're ending yours, and look forward to our next one. Thank you very much for joining us here on CNBC TV 18.